Joining us here at Post 9 at the New York Stock Exchange, Barclays head of U.S. equity strategy, Venu Krishna. Great to have you in. Thanks for coming.
Thank you, Carl.
What do you mean by valuations look pretty full? How full?
Quite full. So if you look at big tech, for example, trading at about 29 times forward earnings, quite full. But when you adjust it for the growth of their earnings, it looks quite reasonable. But when you start stepping out, the rest of S&P outside of tech, trading at around, call it 19 times roughly. We think the fair value is closer to 17 and a half. So probably around a handle to handle and a half rich, but that's not too out of whack. But the point is that in aggregate with S&P, when you put it together at 21 and a half times forward earnings, that's quite full.
Are you suggesting there's downside risk to your year-end target?
No. In fact, what I would argue is that there's upside risk to our targets. Our base case is 5,300. We're pretty close to that. But the upside risk comes from the fact that the market and the economy has continued to surprise for 2 years in a row now. So if you continue on that path roughly, and most importantly, if big tech continues on the path of beat and raise we have seen in the last 18 months, then you could well see S&P hitting 6,000 by the end of the year.
Not this year. End of this year?
It can.
Okay.
Yeah.
I've seen a lot of sixes on 25, but not many on 24.
So I think it's a question of probabilities, right? Our base case, call it 55, 60% probability. The downside case of S&P hitting 4,500 is probably a 10% probability. But then the upside, which is more than the downside, is probably around 30%, right? So not likely, but still, we're in a market where the surprises to the upside, broadly speaking, in the economy level, have continued to set U.S. exceptionalism out there.
What does that mean for asset allocation? If I'm listening to you and you're telling me that the market is priced very fully at these levels, largely due to tech, which does happen to surprise to the upside with earnings, do I put more money to work in big tech despite the multiple that may be a little rich compared to history, or do I opt for something that may be more of a catch-up trade here?
Very good question. So I'll try to answer it in a couple of ways. One is we absolutely think that you need to have the market weight exposure to tech. There's no running away from that, because we have insisted for almost 18 months now that you have to learn to live with narrowness, and the narrowness will be with us for a while, right? But that doesn't mean there are not opportunities outside of tech. The question is, how do you go and find that? It is certainly not in small caps. We think it's very risky. But we do think that the rest of 494 of S&P, if you wear a quality hat, if you wear a growth hat, and if you try and approximate the kind of financial metrics which big tech is delivering, you can't match it, but you can try and approach it. I think there's a way in which you can pick stocks. Don't forget that right now we are at 20-year lows in correlations. In other words, dispersion is very high. This is a stock picker's delight. Unfortunately, most of the stock pickers are underperforming, which shows you the challenge of dealing with a concentrated market, which also happens to be a stock picker's market.
A concentrated market in the sense that the indexes themselves are concentrated, not necessarily the positions of the stock pickers.
Right. And to your point about big tech, the visibility over the next 2 to 4 quarters is very clear and extremely strong. Think about it. The combined market cap of 6 stocks is over 14 trillion right now. And their growth rate in terms of the realized earnings in this quarter is over 50%. Their forward revisions after earnings is up more than 20%. The good news is for the rest of S&P also, revisions are finally up, but around 5%. So you see the huge delta between the two, and that's the reason why you cannot afford not to be involved in big tech, because you have visibility. At some point, you may need to get off the train to some extent, but it's not right now.